Okay, we're going to start today by looking at the S&P 500. You can see that the S&P is holding at the 50-day moving average, and that's a good sign of momentum. We're going to start earnings pretty soon. You can see the 150-day moving average is a good level of support also. So that's the green line. And you can see we're oversold. We're at 24 in the stochastics. 20 is considered truly oversold. Anything below 20. Right now we're at 24. So that is kind of a contrary indicator that the market's oversold. Usually that's time to look for things to buy. Okay, so if we look at our stochastics chart and we can see our trend lines, the S&P is basically behaving very well. It's holding above the 50-day moving average and it's within its trend lines. So we have a certain period of time between now and when earnings start. So that's like a time usually we um, can assume we just have to wait for reports like the jobs report and things like that. We have, let's look at our calendar. You can see where our two holidays are out of the way. Um, we have the January 1st and we have Christmas. So um, we're going to start earnings coming next week. We're going to JP Morgan on the 15th, and then we're going to have tech earnings at the end of the month, starting with Apple. Then we're going to have Google in February. So right now we're still basically we're oversold in the stochastics, and we're kind of between the trend lines. We have a good amount that we could go down before we hit a trend line. But if you see a lot of these other um, charts, you can see a lot of them are at their bottom of their over this gold is oversold and it's at the bottom of its trend line. You can see that this one is the XLY consumer discretionary. It's oversold and it's at the bottom of its trend line. A lot of sectors are oversold, including materials sector. Um, we have the XLI, which is the industrial sector. Okay, so we have a lot of oversold in the stock market right now. And all right, so let's look at some of our talking points. All right, so SP was down 1% from last week. So the Santa Claus rally did not come. This is basically the tail end of the Santa Claus rally. And we still have a lack of momentum in the stock market. We have 54% of the S&P 500 stocks above the 200-day moving average. Um, and we have 22% above the 50-day moving average. So, and we have the 10-year and 2-year up this week. So I think that the 10-year chart, let's look at that real quick. The 10-year chart, let's do a comparison to the S&P. You can see it was moving up this week, and we're in an uptrend. You can see since September, middle of September. And usually, whenever the 10-year yield goes up, the stocks usually go down. And so we see that a little bit now. Let's look more about more of our talking points here. Um, okay, some things I'm concerned about the 10-year Treasury yields. If we see long-term Treasury yields go higher, that is a sign that the debt of the United States could be a problem. And that could, we'll go over that a little bit about that later on. Um, we have Trump possibility of moving the markets on a daily basis for the next 4 years. So those are two things I'm really worried about. All right, so we can see that we're moving into January, which is traditionally a pretty decent month. Um, primarily because we do have earnings coming out. Every quarter, we have earnings releases. So January, we have April, July, October. So these are times whenever the earnings come out, and um, that usually propels stocks up or down a lot. Lately, it's been something that helps stocks. Okay, so we already talked about the oversold nature of the S&P right now. Um, and we have fear in the market also. The 10-year Treasury continues to go up, and that's going to be a problem if it keeps going up for the stock market. All right, so we have the price of oil going up 3% this week. Um, the dollar index, the US dollar is getting stronger. It is up 1% against other currencies this week. Usually, whenever the dollar goes up, usually the price of commodities go down, but that did not happen this week because the price of oil went up and the price of gold went up also. So that trick didn't work for us this week, but we do know that the dollar is continuing to appreciate, um, and that against other currencies, and that usually is an indication that the tech stock, any company doing business overseas, will have to repatriate money, and that's they're going to make less on that money if as the dollar goes up. So let's look at some the fear of greed index. People are becoming more fearful. It was here last week, so now it's at 32 fear. So people are getting more fearful. We're in an oversold state in the stock market. That's like a contrary indicator. It's time to start looking to buy something. Um, all right, so we also have the American Association of Individual Investors. Most are bullish, but it's very, very close to the bearish. So I wouldn't give this a bullish or bearish this week because it's basically almost equal. Um, let's see times when it would be a good time to buy in this investor survey. You can see the people have been bullish for a whole year now. So all right. So I guess we can't get anything from that. All right, so the VIX is at 16 now. It's unchanged since last week. You can see that people are basically complacent. They're not fearful in um, in buying protection, and there's like put call ratios. There's other kind of option like things that the VIX represents. Right now, people are not fearful. Um, so uh, usually, whenever there's a spike like there was, um, rest. Okay. So right now we're at a 16. That's pretty low. So people aren't that afraid. But we have a fear um, in the market. We're not at a capitulation mode. We're not greedy or enthusiastic. So one thing I'm worried about, let's see, is consumer debt. It's becoming an issue. We have a lot of credit card delinquencies. We're beginning to see some um, housing delinquencies, not a whole lot yet. Um, okay. And we're also starting to see high gas prices and actually natural gas prices because of the cold. We're getting a big cold spell in America. So that's going to raise the price of gas due to demand. And let's look at, we're making a new first to worst for this year. You can see that the sectors that performed the worst last year, real estate, healthcare, energy, consumer staples, and materials. We're going to keep track of those and see if they turn around in some way for the next year. So far this year, IT is and consumer discretionary, two of the best sectors. Real estate is up 1.3%. So let's see. We had 2 straight years. Look at this. 2 straight years of outperformance by IT, communication sectors, and consumer discretionary. Um, in utilities, they were the one that did the worst 2 years ago, and they were one of the best this year. So the worst, the first actually um, ended up working for us last year. And so what? A lot of times, this is the beginning of the year. A lot of times, people look at their portfolio and try to move things around to be more diversified. So in in doing that, you have to look at these sectors and say, well, how much is my portfolio in each of these sectors? And do I want to reposition or um, move your portfolio around to be more um, adaptable to the upcoming environment? So we're going to talk a little bit about that later on. Um, so our themes for this year, interest rate cuts are coming. So as interest rates go down, the Fed cuts interest rates, we're going to have a higher demand for higher yielding investments. So those high yielding investments that pay 9, 10% or higher, they're going to be hard to find in half a year to a year because there's going to be lower interest rates. So so they'll be investors investors will be reaching for yield, stable businesses such as utilities, healthcare, and consumer staples. I'm thinking healthcare has been down 2 years in a row. There's a very good chance that there's an outperformance in healthcare. Also, if we have an unpredictable environment where, let's say, the president makes some executive actions that are um, not expected, there's going to be a movement towards safe investments that are predictable. So sometimes utilities and healthcare are more predictable. Okay, we're gonna have a strong dollar. It's been strong all year long, and we're in an uptrend. Because of that, companies overseas that do business overseas that will be negatively affected. The input price of goods from overseas goes down. So as the dollar appreciates, the price of foreign goods that we import go down. The price of commodities, oil, and gold also go down. So other things we think about for the coming year, deregulation, that should help financials, banks, oil, and crypto. We don't follow crypto at all because it's out of scope for what we're doing here. Deregulation will also allow more IPOs to market and will allow more deal making. So there'll be some takeovers this year that wouldn't have happened last year, for instance. That's good for Morgan Stanley, Goldman, and some of the companies that lend money to others, like Apollo Management. And um, the other theme is Department of Government Efficiency and the the effect of all the changes that they're going to recommend and make. So that could disrupt established business models. For instance, there might be a cut in defense spending. There might be cuts in jobs. So there's going to be less economic activity if there's less people working. And so we don't know what's going to happen because we know it's coming. And but we know that there's going to be uncertainty, more uncertainty this year than last year because we had a predictable political environment when nothing happened. So now we have Republicans taking control of Congress. So um, possibility of a lot of changes happening and affecting businesses we're watching is greater. And the other theme is AI growth tapers this year. That means it was growing gangbusters last year, but it'll grow maybe instead of 50% or 100%, it'll grow 20%. So a lot of stocks have to be re-rated because of that. For instance, if Nvidia was growing like 100, it went up 160% last year. This year, they might not grow 120, their earnings 120%. They might only grow 20%. We don't know that, but that's an example of AI growth tapering. So the stocks will have to adapt. Their prices will adapt to as their earnings come out. All right. So as you can see, we have the energy sector doing pretty good this year and utilities. And so let's watch the utilities and energy because energy sector has been down for 2 years in a row. We were talking last week about the possibility of um, energy being the best performing sector this year. And there's a possibility that that could be a sector that has stability. It's in dividends when there is some chaos going around in the world and in the presidency. Utilities are also kind of a conservative sector that has the AI head tailwind. They have a lot of demand for energy due to the AI infrastructure. And communication sector and IT, they did good for the last 2 years. They're also starting to do good this year too. And let's see. All right, so let's look at some of the stocks that are going up and down. Okay, first of all, let's look at the 10-year. It's been going up recently. So as our little cheat sheet for understanding that is as the 10-year goes up, positive for large cap tech stocks, for financial sector, insurance companies, brokerage firms, and insurers. Let's see if that happens here. Okay, we have a lot of tech companies in the top 10 of the market movers. We have Supermicro. We have a lot of AI infrastructure companies. Every one of these companies has a part of the AI build out of the data warehouses, of the data for the AI companies. So you have Vistra. They were the best performing stock last year in the stock market. Um, they help with the building of data centers. Supermicro, they also build the servers. Tesla is an AI branded company. It's probably up because of um, Elon Musk helped Donald Trump, and there's been a run on Tesla since the election. Palantir is a AI related company. Energy is a company that does, of course, electric transmission. NVIDIA, of course, we know. G Vernova, they do. So a lot of these are energy companies, and look at the ones that are doing the worst. Dollar Tree, why would they be down? Well, there's tariffs coming, and where do they get most of their dollar items from? China. I'd say 80% are from China. So if there's 30% of tariffs on the things they import, just think of how much that they have to raise their prices to $1.60, instead of $1.25 at their stores to make the same amount of profits. So they're going to have a problem if there's massive tariffs. Molson Coors Beverage, why are they going down? Um, there's a news story this week about possibly putting cancer warning labels on alcohol. And if that's put on alcohol labels, just think, just like cigarette packs, if there is cancer warnings, that's going to reduce the amount of alcohol that's being drank in America. So let's see, Brown-Forman, they're an alcohol company also. And okay. So we have that's an example of government making a role, and it totally affects the companies. We have what are the companies that are going up and down? Okay, we have some highly indebted companies. We have Norwegian Cruise Line, they have a lot of debt. We see Carnival Corp, they have a lot of debt. Um, these cruise lines had to borrow money to stay um, alive in the pandemic, and they're still trying to pay off that money they borrowed. So that's why it's very important whenever you buy stocks and investments, you have to look at the debt on the balance sheet. You have to make sure that they it's sustainable. All right, let's look at the sectors ETFs. We know that the rates are going up. So the rates are going up. So we our large cap tech stocks, financial sector, insurance companies. Let's see if that's what what's going up today. Regional banking ETF. Okay, so banking, telecom, bank. Okay, let's look at the ones going down the most. Gold, possibly because the US dollar is going up. We see the gold miners and gold related investments going down. Maybe that's the reason why. We have materials. Okay, this materials also are affected by the dollar. So as the dollar appreciates, you also have the pricing of materials and mining go down. So let's look at retail. All right. So the ones that are we see the ones going up the most, telecom, regional banking, telecom. Telecom pays high dividends. Real estate. All right. All right. That was a good little exercise. Let's look at some more talking points. Okay, so I'm waiting for Dan Niles to give us his 2025 top picks, and we're going to take him serious with this year. Last year's 2020, his returns from the beginning of last year on his picks: Amazon up 54%, Meta up 75%, KWeb only 11%, Texas Instruments up 17, and XBI up 5%. So Meta was like by far his best investment idea from last year. And so why did Meta go up so much? They used AI to um, add to the value of their advertising for their customers. So people clicked on more ads and generated more profits because of AI. And they had election tailwind. So there was a huge election spend last year, and there's not going to be that this year. So it's going to be really hard to compare earnings from last year to this year for Meta. And Amazon, they did good because mm, their advertising improved and their AWS data business is doing good too. Um, all right, so we'll keep showing his last year's picks until he gives us this year's picks. Um, okay, there's an article here. This guy, his name is David Miller. He runs a mutual fund. The mutual fund is Catalyst Funds. Okay, so Catalyst Funds, and he says he's pretty bullish on equities for the next year. And the reason why I like this, I watched this, and he's hunting for higher earnings growth, and he says he's focusing on basically the same things that I actually am looking for in when I'm looking for stocks to invest in. He looks for revenue growth, earnings growth, return on equity, return on capital, current and forward PE, high free cash flow, and high margins. Okay, these are all things we've been highlighting for like the last couple of years. So it was really good to watch this and to see his take on the current environment. His main points in this article was S&P, let me see, top companies have higher earnings quality. So even though they're trading a little more expensively, they are better earning companies than the other ones. Um, Low corporate taxes are good for earnings per share of S&P and Nasdaq. And he thinks the coming administration will lower the corporate tax rate. So that'll be something that'll help the companies. He likes Google, Nvidia, and Meta, but Alphabet is his favorite stock. He says it's the cheapest of the Mag 7. It's a PE of 22, and they're growing at 12% pretty consistently every year. And they have um, uh, a dividend also. And he said they have a 4% earnings yield. I don't know what that is, earnings yield, but I'm going to start looking into that because, the cloud revenue for the company, um, Google Cloud is growing at 30%. So, um, so he didn't mention the Waymo, but um, there's a lot of new products that are being developed by Google, such as Waymo and um, quantum computing chips. So there's a lot of things. That's another reason I like investing in Google because they're constantly reinventing themselves. And so that was good. Let's look at some of the things that this guy holds in his Catalyst fund. I expected to see a lot of stocks, but actually, these are mostly exchange trader funds. So you see Spider. I couldn't believe it when I saw it, but he basically considers himself, I guess, an asset allocator because a lot of these are just ETFs. Um, so we couldn't get anything. We couldn't get anything from his top holdings. Um, Here's another article that came out this week. Zepbound will dominate obesity market following Surmont 5 results. So basically, what's happening on an ongoing basis is this Zepbound drug that Eli Lilly is selling is going through a lot of these trials and in studies, and they're finding that it's like almost a wonder drug. I mean, they're reclassifying this drug to be used by a lot of different for a lot of different use cases, and that's going to make the drug sell more in time. But right now, we know that Eli Lilly is selling as many as they can make, as much of this product, Zepbound, as they can make. And they're building factories to make more. And they're the only company that's able to produce this amount of medicine because there not too many companies can invest several $billion in a new facility to create these things. So basically, we have studies coming out that they're the best of the weight loss drugs. So he expects them to take the lead in the market for obesity drugs if it hasn't already done so. That is um, that is pretty amazing because from last year to this year, they've grown their earnings over 100%, and they're expected to grow 70%. They're earning 70% in the next year. I divided 22 by 13, and then they're supposed to grow at 32 and 20%. But they haven't even started advertising this yet in a major way. They said they're waiting for their supply to be online before they advertise. And they just opened their China. China just approved them to be sold in China. So they have a huge worldwide market for this product. And they're making more than any of the weight loss drugs than any other company. And they have the best product. So you think the doctors will prescribe this over other ones because it's more potent and it works better. So right now, let's look at their numbers. They're growing. Let's say it's 71% from this year to next year, and their PE ratio is only 34 right now. You can see there was a pullback, a massive pullback in the stock whenever RFK Jr. was um, added to Trump's list of people to help him run his administration. There was a huge sell-off on these drugs, but we don't know exactly how that's going to work out. But I'm going by the numbers, and it seems like they're undervalued by half off. I mean, they were totally overvalued um, last year when we were looking at this. They were trading at a premium, but they pulled back at least what 20% from the 900s. And so anyway, so I think the fair value is a lot higher than what it is right now. It's probably closer to 1,000 or something, or 1,100. So, anyways, I'm invested in this. I'm just waiting for them to get as much drugs as they can sell, and I'm waiting for these numbers to go up. Yeah, and we'll see what happens over as they have enough medicine to sell. Another good thing, headwind for this company, um, is let me see, hold on. The government just mentioned that they are not supply constrained anymore. That means there's enough of their drug for anyone who wants it. So there's something called compound medicine. There's companies that make fake versions of this product, and they're allowed to do it if there's a short supply of the product. But this compounding stopped whenever they said they have enough supply. So that means they're going to stop the people making the compounded generic fake versions of the product, and now they're going to start selling it at their price. We'll see what happens there. You can see for their their statistics. Their 4P is 34, and their PEG ratio, according to Yahoo Finance, is 0.73. So Yahoo thinks it's 30% undervalued. So if you look at its current price of 78, they think it's worth, let me see, let's do a calculation. 781 times 1. They think it's worth $1,000 a share. Okay. And you can see the profit margin is double what we're looking for. And return on equity is like 6 times what we're looking for. So it's really good numbers all the way around. This is an undervalued, it seems like an undervalued stock that's currently out of favor. The drug group is totally out of favor. Um, so we don't know how long it's going to be out of favor, but we can see um, one of Peter Lynch's favorite. This is one of Peter Lynch's favorite graphs. The earnings, which is the gray bars, and the actual price of the stock. Now, Peter Lynch liked it whenever the price of the stock went down here, it kept on going down as the earnings kept going up. So this is an example of a stock that's um, we don't know how long it's going to be out of favor and what rules, let's say RFK Jr. will set in the new administration if he's appointed. But looks pretty good. All right. Here's another here's another article on um, Dan Ives. He listed his top 10 winners for the artificial intelligence revolution. We had this from last week. I'm going to keep track of his stocks, and you can see that MDB, they do databases for data software for data centers. Palantir, they're a AI company that's implementing AI for a lot of really big companies and the defense contracting companies and the government too. And we have, um, I think it's Snowflake. Yeah, Snowflake. They're up 5% from last week. So we'll keep track of these. We'll learn more about these companies as we go along. Um, Dan Ives is pretty smart. He's like a cheerleader for AI and for a lot of the big tech stocks. And when a lot of people are not confident in the AI or the Mag 7 stocks, he likes to cheerlead them and say, "Hey, this is a long-term 10-year um, investment cycle." So he's part cheerleader, so it's hard to really take him seriously. But um, so far, his pick's been doing really good. He did choose Palantir last year, which is one of the best of the stock market from last year. But he thinks that most of these are AI companies. He thinks that we're in the first inning of a 9 inning ball game for AI. All right. Okay, here's an article from Yahoo Finance. Elon Musk says that there won't be any money for Social Security, um, and that the United States is looming for bankruptcy. So he thinks that this um, the government is spending more than they should, and they're having interest payments that are more than they can afford. And if they don't do something fast, we're going to go bankrupt. And um, that's going to like mess everything up for the stock market, for anything that you've saved in your whole life. And um, let's hope that the Department of Government Efficiency kind of reduces the government spending, because I'm not sure exactly how to protect your portfolio against a United States defaulting on their debt. So I'm not sure what's going to happen here. I would listen to this YouTube towards the end of this YouTube video, and just listen to what he said about this. He basically he says that we need to reduce our debt by 30%, or spending by 30%, or we're going to go out of business, basically bankrupt. How do you protect your portfolio against maybe this happening? Um, Things you can do is potentially buy gold, because gold holds its value outside of currencies. Let me see. We can hope that U.S. will get its costs under control, which hasn't happened for the past forever, and maybe buy houses or assets that will retain their value even if inflation goes up. I'm really not sure how to handle this. Right now I'm handling it by holding stocks and hoping that the U.S. will get their costs under control. But I'll research this, figure out what ways to protect against something like this happening. Um, Warning signs. This is why I'm so concerned about the 10-year and 20-year Treasury. If their yield skyrockets and goes up and continues to go up, there's a good chance that we could have some rampant inflation or hyperinflation. Translation is, a banana will cost like $100, and the money that you saved your whole life could end up being like worthless. So, anyway, this is like a black swan that everyone knows about. Um, I'm not sure exactly how to handle this, but I'll continue to research it. Um, all right. Okay, this is a nice little chart that I got from Twitter, X. Okay, it's a creative planning reference guide for 2024-25 tax reference. Now, there's tax brackets. We have long-term capital gains. So if you're at a certain tax bracket, married, filed, you're single, and you make 48 to 53, you're going to pay 15% capital gains tax, for instance, if you sell some stocks and you have a realized profit. And here's some more deductions and exclusions that are um, for the year 2024 and 2025. So this is a really nice chart for planning your taxes. A lot of times, whenever I'm looking at tax brackets, it's really important to know where your tax bracket is, and if you're on the edge of one of your tax brackets, then maybe donate to charity or donate to put money towards, an IRA. You get your total taxable income within the lower tax bracket to pay less taxes. And here's some contributions that you can make for your retirement plans. So this is a really nice little, let's try to enlarge it a little bit. Okay, so I'll include this in our notes for this talk. All right. All right, so there's another story from James K. Glassman from Kiplinger. This guy picked out a top 10 stock picks for 2025, but his picks weren't all his. The only pick that he chose of all these was Constellation Energy. It's up 13% this year. But all the other stocks, he actually had looked at other people's top lists and he chose them from that. For instance, Adobe was the top pick from Morningstar as a stock that had a high moat. So I went and I said, well, let's look and see if his picks have any credence, see if they are undervalued in some way or have some kind of value. I said, well, let's look at these ones here, Heiko, because Warren Buffett actually has that as part of one of his stocks in his portfolio. I thought I'd look at United Health. They've been in the news recently, and we're going to look at Constellation Energy, and we'll just look at those to see if this guy has a good stock picking mindset. Okay, so what I did was his article right here, he lists the reason why he picks each of these stocks. And for instance, let's go over the first one. His first pick is the top holding of a microcap mutual fund. So this wasn't his pick, it was the top holding of a microcap fund. So this is a really, really small company. Um, and this company, Celebrite, is their revenues grow 50%, um, and they do software that investigators use to recover vital information from cell phones, almost like a hacking software. And so, but it's a very small company. And he didn't, and I don't know a whole lot about microcap stocks, so I tried to pick stocks that are a little bit bigger. Um, so Warren Buffett bought this company called Heiko. They do global defense. Um, they do replacement parts for the aerospace industry. That's their major product. He said they're going to be growing their earnings for 17% for 5 years. So I thought it'd be interesting to review that one to see if it's worth buying. Um, some other ones, MGM Resorts, we know they're a gambling company. Um, for me, gambling companies aren't that predictable. Um, so, and they really failed whenever there was a shutdown of the economy during COVID, so the pandemic. So because of that, I didn't want to look into MGM. Um, okay. Okay, Zeta Global Holdings, they use AI to examine data points to predict customer preferences. That's another smaller company. So, you see, he thinks Malaysia ETF is a good pick. I don't know anything about Malaysia, so I didn't really look into that. He said they're declining 5 of the 6 preceding calendar years. Um, I think the United States has outperformed every major country in the past 10, 20 years. So I'm trying to stay away from foreign companies because I don't understand them very well. Okay, so He likes Adobe, Whirlpool. Whirlpool has a lot of debt. I know we looked at that before. I like to stay away from companies with a lot of debt. But we're going to look at United Health Group. He thinks the reason United Health is good is earnings have risen in a beautiful line. Okay, so he thinks that earnings are going up in a straight line every year since 2008. So it's very consistent, predictable earnings. Double digit through this decade. Okay, so it only returned 6.9% in the last year, where the whole stock market went up 25%, 28%. So he thinks this is an example of a stock that is bound to go up again. Constellation Energy, they have demand for electricity booming thanks to AI data centers and electrical vehicles. So we're going to look at those three, the ones that are green. Okay, so Heiko, this is the company that does uh, parts for aircraft. And you can see, based on their earnings, they're only growing maybe at 15% a year. The forward PE is 55. That means they're overvalued by 3.6 times. Usually when I see that, I say, okay, I'm not interested because there's no margin of safety. If they end up missing on earnings for some reason, they're going to go down to their fair value, which is something like 65. So I'll wait for it to go down to 65 before I start looking at it. You can see that there's in their statistics, their PEG ratio is 3.81. So even Yahoo Finance thinks it's 3.8 times overvalued. Their profit margin is the bare minimum that we're looking for, and their return on equity is 14. So it's not that great. And they're overvalued. So we're going to stop looking right there. Their debt isn't that bad either. Okay, so let's look at United Health. According to the article, the guy that wrote this article, this is in a straight line up. You can see, you can see that this is appreciating somewhere around 10%, like just like the guy said in the article, in a straight line up. You can probably draw a line, that goes from bottom left right here to here. So they're growing at like a steady 10%. But the problem is their PE ratio is 17. So they're growing at 10%, but their P ratio is 17, so they're overvalued by 1.7 times. We divide 17 by 10. So there's not a whole lot of margin of safety for this. Um, so they're currently traded at 513. We divide that by the 1.7, you get $301. And if there's like a total sell-off in the stock market, usually stocks that are this high quality that go up 10% regular basis, they'll trade down to 300. So I like to buy stocks right around a PEG ratio of 1, if possible, or lower. So recently they had pretty bad PR for denying claims. And of course, they had a CEO that was shot. And maybe they might be forced to not to cave in to some people to give them some care that they normally would have denied them. So they might not be as profitable. So it's like not only they're overvalued by just a little bit, they're they have this news story that they might have to do something publicly to be a better insurance company. So too many problems for this one. I'll wait for it to be on sale. Their profit margin is very low. Look at that. It's at 3. So they have razor thin margins. That's really bad. Like at least 13 or 12 or something like that. Um, you can see Yahoo Finance thinks it's 40% overvalued. It's 1.42 PEG ratio. And the return on equity is 16. That's pretty decent. Um, you can see that they have around 40,000, 40 mil, 40 billion in debt out of 500, which isn't bad at all. So all in all, it's overvalued. There's no excitement right here in this right now. We know that this stock is in a lot of the top 10 mutual fund holdings. So because of that, there's a it's overvalued, but we know it's going to be growing around 10% a year. Right now, I don't want to pay that 70% premium. It's 1.7 times more than it's worth. All right, so let's look at CEG, Constellation Energy Corp. One thing about this company, I was looking at its numbers. It's not, they had a really good growth, 76% from last year to this year. Um, but they're only growing like 10% for the next couple of years. We don't know how much demand they're going to, how much more money they're going to make from the data centers. And we know that this company was involved with Microsoft, where they restarted Three Mile Island to give them all the energy. Microsoft took all the energy from Three Mile Island nuclear site. So that was unexpected. That's probably where the 76% comes from. But how much more are they going to make every year? Right now, the estimates are only saying 10%. So 3% for this year to next year, then 10%. It's still overvalued by 2.7 times, but so it doesn't have a whole lot of margin of safety, but it does have momentum. Look at this. Look at these. They missed their earnings estimates almost for a whole year in a row, but all of a sudden they're making a lot more than they used to. So this is kind of unpredictable. The earnings estimates aren't going up enough for me to be interested. So if it went down to $93 a share, I would be interested then because that's the current PEG ratio is 2.7. So if you divide the current price by 2.7, you'll get, what it's trading at. We'll check back in like a half a year to see if these estimates are going back up due to all this AI demand. We don't know. All right. Well, it's a good exercise. I think that's it for my talk. If you have any questions during the week, let me know and I'll try to research them for you. In the meantime, thanks for attending and I hope you have a good investing week. See y'all.